Assumable mortgage has a couple of advantages. The truth is, it's not just the buyer that's going to get a lot of benefits with this type of mortgage. A seller can actually get some benefits as well. That's especially true if the interest rate that's currently on the loan is actually lower than what the buyer would get with a new loan. Think about it. If the current rate is 7% and the old loan is at 5%, that means the buyer is saving hundreds of dollars every month. Next, there aren't going to be as many closing costs, which benefits the buyer because it saves money. It also benefits the seller because they can likely get a better deal with the buyer for the purchase price. What's really great for everyone is that when you assume a mortgage, it's a very simple process. A lot easier than getting a whole new mortgage. And that means there's less time involved, and there's not a requirement for a property appraisal either. All of that is going to make things a whole lot easier to get through. When it comes to the seller, they actually have an upper hand on the market. Not just any mortgage can be assumed, but with benefits that come along with it, that could be an asset. It could make a homeowner more interested in buying the house. On the other hand, you should always consider the drawbacks. As with anything, there will be situations where this isn't the best option. For a buyer, it's important to look at the purchase price versus the amount of the mortgage. Is there going to be a down payment or some type of financing required outside of the assumable mortgage? The $200,000 house we talked about earlier, with the $270,000 purchase price, is one example. The buyer would need to come up with $70,000 in cash or additional financing in order to buy the house. That extra money could be at a much higher interest rate than the mortgage. A second loan generally means a second mortgage company, and that could make it difficult to get everything sorted out. The two companies may not want to communicate with each other, or they might be reluctant to take on this kind of arrangement. For the buyer, it becomes more of a hassle and not so much of a benefit anymore. When it comes to the seller, there's always the possibility of being held liable for a mortgage that has already been passed over to someone else. If the buyer defaults, it could come back on the seller, and that's definitely not something they want to deal with. Getting a written copy of the release of liability from the mortgage is essential to prevent this. Finally, you should know that Federal Housing Administration loans and Veteran Affairs loans can be assumed, but most conventional loans can't. On the bottom line, when it comes down to it, it's entirely possible that an assumable mortgage will be the best option for you. It's all going to depend on interest rates and the type of mortgage that you're getting, as well as how much the purchase price is versus the assumed mortgage cost. Just make sure you talk with the lender and see if everything is going to work out best for you this way. That's it for now. On our website, you can find more posts as well as calculators and other financial tools. Considering an assumable mortgage? We would love to know your thoughts, so feel free to share them with us in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel to get the best financial videos for free.